While everyone was watching silver prices rocket upwards, the market quietly broke. China just triggered a sharp targeted price takedown in their domestic market, and almost no one in the West is talking about what this really means. This wasn't some random sell-off, it was a calculated move that came right after new export controls went into effect on January 1st, 2026. In this video, I'm going to lay out the real story behind the Shanghai liquidation and what it signals for the physical silver you're holding. The gap between the paper price and the physical reality has never been wider, and what's happening in China is the key. Stay with me because the details are stunning. First, let's set the stage because the volatility we've seen has been absolutely historic. For the last year, silver has been on an unbelievable run. After surging in 2025, it exploded again in early 2026, reaching a stunning peak of over $121 a troy ounce. The entire financial world was buzzing. Mainstream outlets were finally forced to cover the devil's metal, and a wave of new money poured in, chasing that parabolic move. But then, just as the euphoria hit its peak, the floor fell out. In just a few trading sessions, the price cratered. We saw a major sell-off, with silver plummeting from its highs. Now, on the surface, the talking heads in the financial media called it predictable profit-taking. They pointed to news about the US Fed and tariff announcements. As the pin that pricked the bubble, they told you it was just speculators getting flushed out, that the rally had run too far, too fast. And you know what? They weren't entirely wrong. There was a massive liquidation, but they missed the most important part of the story. They missed the location and the method. This wasn't a global, synchronized sell-off. This was a targeted demolition that came straight from one place, the Shanghai Futures Exchange, while COMEX prices in the West wobbled. The real epicenter of this earthquake was in China. This is our first clue that something is deeply wrong with the official story. Why would the market break so violently in the one country that has been desperately consuming every ounce of silver it can find? Why would a crash happen in a market where physical silver was trading at a huge premium of over 10% to the global price, signaling incredible demand, not weakness? The mainstream story just doesn't add up. To find the truth, you have to look past the lazy headlines and dig into what actually happened in Shanghai. You have to follow the trail that leads directly back to a policy decision made by the Chinese government, a decision that changes everything. To get to the real story, we have to connect three crucial puzzle pieces: the speculative frenzy, the margin call cascade, and the dragon's new horde. First, the speculative frenzy. The run-up in price was fueled by an army of retail speculators in China. For months, they piled into silver futures, creating a localized bubble. Demand was so hot that prices on the Shanghai Futures Exchange (SHIFE) were consistently trading at a huge premium to prices in New York and London. This premium is critical. It was a giant, flashing sign of a desperate scramble for physical silver inside China. This brings us to the second piece, the margin call cascade. Chinese authorities saw this speculative fever and decided to smash it. The Shanghai Futures Exchange moved aggressively, not once but multiple times. They jacked up margin requirements, forcing traders to put up more cash to hold their positions. This is a classic move to flush out leverage. But here's the kill shot, the detail the Western media completely missed. According to insider reports and market analysis, the SHIFE went a step further, reportedly making it nearly impossible for many speculators to take physical delivery. Think about that. You could have a contract expecting to take delivery of physical silver, only to be told you can't. You are forced to sell. You have no choice. This triggered a tidal wave of forced liquidations as thousands of over-leveraged speculators were wiped out. It was a controlled demolition. The crash wasn't the market speaking. It was the exchange pulling the plug. So why would they do this? Why orchestrate such a brutal takedown of their own market? That brings us to the final and most important piece of the puzzle. The dragon hoards its silver. On January 1st, 2026, a new law went into effect in China. Silver was officially reclassified from a simple commodity to a strategic material, putting it under strict regulatory control. An export license is now required to ship silver out of the country, and these licenses are only being granted to 44 state-approved firms that meet incredibly strict criteria, like producing over 80 tons a year. Let's be crystal clear. China refines and exports a massive portion of the world's silver. By implementing these controls, Beijing has effectively seized control of a huge chunk of the global supply chain. They are building a silver fortress, prioritizing their own colossal industrial needs for solar, EVs, and high-tech electronics. So let's connect these dots. This isn't a story about a simple market crash. It's a story of a calculated, strategic economic maneuver. The Chinese government, knowing they were about to choke off a huge portion of the world's silver supply with their new export controls, had a problem. Their domestic market was a raging inferno of speculation, with prices spiraling out of control. If they implemented the export ban while their domestic prices were at nosebleed levels, it would create chaos. It would make it impossible for their own industries to source the metal at a workable price. So what did they do? They expertly and ruthlessly engineered a market takedown first. They used the margin hikes and delivery restrictions to purge the speculators, break the fever, and push the domestic price back down. They cleared the deck before locking the gates on their national supply. This is the real story no one is telling you. The price drop wasn't a sign of silver's weakness. It was a display of China's strength and strategic foresight. It was a necessary step in a much larger plan to dominate the physical silver market. While traders in New York and London saw the headline price drop and hit the sell button, they were reacting to a manufactured event. They were looking at smoke and mirrors completely, oblivious to the fundamental market shift happening behind the curtain. This creates the US vs them narrative that is so crucial. The paper markets, like the COMEX, trade a derivative of silver. They react to news, algorithms, and sentiment. But the physical market for real bars and coins tells a story of geology, chemistry, and logistics, and the signals from the physical market are screaming the exact opposite of what the paper price suggests. They are screaming shortage. If you ignore the noise of the paper markets and look at the evidence on the ground, a completely different picture emerges. It's a picture of extreme physical tightness. First, look at the vaults. They are being drained. Inventories in the Shanghai Futures Exchange warehouses have hit their lowest levels since 2015 to 2016, even with smelters running through the Chinese New Year holiday, a time when inventories usually build. The stockpiles continued to shrink. That tells you demand is relentless. At the same time, we're seeing inventories fall in the western hubs of COMEX and London as well. The metal is disappearing. Second, the market is in backwardation. This is a technical term, but it's incredibly important. Backwardation is when the price for immediate delivery of a commodity is higher than the price for delivery in the future. It's an abnormal condition that signals one thing: desperate, urgent demand for physical metal right now, industrial. Users and investors are willing to pay a premium to get their hands on the metal today because they fear it might not be available tomorrow. The presence of backwardation in the Shanghai market is a five-alarm fire drill for the physical supply chain. Third, and most importantly, is the global supply deficit. This isn't a new problem. The silver market is on track for its sixth consecutive year of a structural supply deficit. From 2021 to 2025, the cumulative shortfall was a staggering 800+ million ounces. For 2026, another deficit of around 200 million ounces is projected, and that's before accounting for the full impact of China's new export restrictions. The world is consuming far more silver than it mines and recycles, and we've been plugging that gap by drawing down on inventories. But those inventories are now dangerously low, and China just put a do not sell sign on one of the biggest stockpiles. These are not the signs of a weak market. These are the classic textbook indicators of a market on the verge of a historic physical squeeze. The paper price may fluctuate, but the physical reality is undeniable. If you're starting to see the massive disconnect between the paper price you see on TV and what's really happening on the ground, make sure you subscribe to this channel and hit that bell icon. This story is moving faster than ever, and I'll be here to bring you the analysis the mainstream media refuses to touch. The information I'm about to share on what this means for your portfolio is something you can't afford to miss. So, what does this all mean for you, the person who understands the value of holding real, physical silver? First, you have to learn to ignore the noise. The big price drop in Shanghai was a smokescreen. It was a strategic reset, not a fundamental rejection of silver's value. The real headline is that the world's largest refiner and supplier of silver is now hoarding the metal for itself. This is a tectonic shift. The flow of silver from east to west, which the world has relied on for decades, is being squeezed shut. The consequences for global industry are going to be severe. As China prioritizes its own green tech and electronics industries, manufacturers in the United States and Europe will find it increasingly difficult and expensive to source the silver they need. This brings us back to the critical divergence between the physical and paper markets. While the COMEX paper price might drop on any given day, the price to acquire actual metal is telling a different story. We saw huge premiums in Shanghai before this crisis. We're seeing lease rates, the interest rate to borrow physical silver, spike. Two levels that signal extreme scarcity. This is the reality the paper markets are hiding. The price on a screen is an illusion if you can't get the metal delivered for that price. What China's move has done is expose that illusion for all to see. This isn't about predicting the price next week. This is about understanding a fundamental restructuring of the global supply chain. China is playing chess while the West is playing checkers. They are securing the real-world assets required for the 21st century economy, and the paper markets are just a tool they use to manage the process. The implication for you as a physical holder is that the insurance policy you own just became infinitely more valuable. The underlying asset is being cornered by the world's second largest economy, and the rest of the world has not even noticed. So where do we go from here? Even some on Wall Street are starting to wake up, even if they don't grasp the full picture. After the speculative froth was blown off, some major institutional players are now forecasting a much higher silver price. JP Morgan, for example, is forecasting an average price of $81 per ounce for 2026. But for us, the people who focus on the physical market, the real signals aren't analyst reports. They are the real-time data points that reflect the physical squeeze. First, keep your eyes glued to the Shanghai premiums. The spread between the SHIFE price and the COMEX price is the most important number in the silver market right now. As long as that premium remains high, it's confirmation that the physical squeeze in Asia is on. Second, monitor the inventory levels. Watch the registered inventory at the Shanghai Futures Exchange, but also at the COMEX and LBMA vaults. As those numbers continue to fall, it's irrefutable proof that demand is outstripping supply. Finally, watch for any news about China's export licenses. How many are granted? How much tonnage is allowed to leave the country? Any further tightening of these controls will be another nail in the coffin of the globalized silver market we once knew. The demand drivers aren't going away. The appetite for silver in solar, EVs, and now AI data centers is inelastic and growing. The supply response is not coming. It takes over a decade to bring a new silver mine online. We are in a structural deficit that is now being weaponized by a global superpower. Let's bring it all together. The historic volatility in the Shanghai silver market wasn't the beginning of a bear market. It was a brilliantly executed maneuver by Beijing to purge speculation and regain control of its domestic price before slamming the door on exports. The real story isn't the price drop. It's the reason for it. It's the story of a nation cornering the market on a strategic metal. It's the story of a deepening global supply deficit that is about to become painfully obvious to the rest of the world. And it's the story of a growing chasm between the illusion of the paper price and the hard reality of physical scarcity. For years, many of us in this community have said that one day the disconnect between the paper and physical markets would break. We are watching it happen in real time. The paper price is a distraction, the physical squeeze is on, and those who understand the difference and who have secured real, tangible assets will be the ones who are truly protected. Let me know what you think in the comments. Are you watching the paper price or are you watching the vault inventories? Like this video to help spread this message, and I'll see you in the next one.